Andrew Liver is telling reporters at its investor day yesterday he's skeptical of a big bounce back in China, but he says there is the beginning of a return to buying power. Is the world's second largest economy likely to regain its strength in 2013? Adrian Moad is a chief Asian and emerging market strategist for JP Morgan. He joins us on the phone. Adrian, it's always great to speak with you.
Hi there.
The economic data and the currency markets are telling us something very different from the stock market in China. PMIs for November, 7-month high there. The yuan posted its 4th monthly gain, its longest winning streak in more than a year. And yet the stock market, the Shanghai Composite, is at levels not seen since 2009. And you think it is the stock market that's getting the story right, correct?
Yeah, we've got a real contrast here between what the local investors are telling us with the A-share market hitting 4-year lows and the H-share market, which is the Hong Kong-listed stocks, which have been doing reasonably well since the September low point. Some of the data has improved. You know, the PMI data, as you were highlighting, has moved above 50, but it's still below 51, so hardly a resounding strength in the economy. And we have had better monetary data as well. So the monetarists are arguing that as more credit is available in the economy, you will see an acceleration into next year. What we've been focusing more on is profitability. And we've seen profits barely grow in China this year, just 0.5. But top line or sales growth has been 14%. And the problem in China is too much capacity. And what we think is going to happen as you look into 2013 is companies are going to cut back on capex. And this economy is 47% fixed capital formation. So it is quite possible that growth slows into 2013 as companies focus more on profits, which might be good news for me as an equity investor in China, but probably not good news for those that are dependent on high Chinese economic growth.
And we have heard that in terms of data points that we're getting from the likes of Yum Brands warning of a recent slowing in China. But you're saying essentially that the consumer could face more headwinds in 2013. And so therefore, these multinationals that are highly leveraged to China, we could see some more troubles ahead for them?
Yes, I think there's two sides to the story. There's one is they've been opening too many stores, and this is across the retail and the residential, across retail and restaurant space. The other side of this story is that China's got a shortage of workers. The non-skilled part of the workforce, the non-graduate part of the workforce is already contracting meaningfully. And this means that you've got tight labor markets even with low growth. Wage inflation is 15%. So there's a margin squeeze there because of a lack of labor, which may sound like an odd thing to talk about in the world's most populous country. But the working age population has peaked in China. But more importantly, there's a skill mismatch. With many, many more kids going to university, it means the supply of non-graduate labor is contracting quite fast.
Adrian, what most people watching you now will want to know is whether China can put a better bid under commodities. Do you think that's likely in 2013?
No, my call is that China will consume less commodities in 2013 than it did in 2012. Housing starts are down about 15% in China this year. It takes a while for the decline in housing starts to feed through to a decline in raw material use. As I already indicated, profits are weak, which the rational response to that is to cut back on capex. So I think it's possible that China produces less steel, less cement, less copper, less aluminium next year, and that the commodity bulls get a bit of a shock by that.
Adrian, we just showed a chart showing the Hang Seng versus the Shanghai Composite, with the Hang Seng, of course, showing a great outperformance. You are underweight China equities. Does that necessarily mean that you are skeptical of the gains in the Hang Seng?
Yes. I mean, one of our problems in trying to go neutral, let alone overweight China, is that the big stocks in China are producing generally disappointing profits. And so I think the right thing to do is to remain underweight H shares and obviously underweight A shares. There has been some interesting moves in sectors like the banks, which have performed well more recently, and we have been a little bit more constructive there. Our concern now on the banks is they account for over 40% of the profits of the MSCI China index, even though they're only 20% of market cap. And we worry that that very high level of profitability will not be allowed to continue in an environment where the industrial sector is suffering weak profits.
Adrian, thank you for your time. Appreciate it. Adrian
Pleasure.
Mowat of JP Morgan.
Thank you.